So this is chapter 3, and this is all about things that go into gross income. That we have our adjusted income. We also have a gross income calculation that we make that can affect certain things. And some things are included in your income and some things that are excluded. And so this whole chapter is kind of on those things that go in and those things that don't go in. And I think I'm going to add, I don't know if we're going to add another handout or maybe another page to this one. But there's a couple things I want to talk about this week. What do I have here? Okay. Okay. So we'll go over, we'll just start going through the handout. Hopefully this will be a shorter class today. We'll see. All right. Most people are on a cash basis income. And that's that if you're a sole proprietor or even as someone in general, that it's when you receive the cash is when you count it. That's when you count it as income. Even if you receive it in advance, it's considered income, which is different than a regular accounting. The general rules for regular accounting. So let's go to Generally Accepted Accounting Principles and IRS. We have revenue, earned for GAAP. So until you earn it, it's not considered revenue. The IRS counts revenue when it's received. And their idea is this: look, if you receive the cash, you can pay the taxes on it. So kind of the general rule is when it's received. There's an exception here we'll talk about in a minute. But for GAAP, it's when it's earned. So until you earn it, you can't count it as revenue. The IRS, they don't think about it that way. They say, well, when you have the cash, you can pay the taxes on it. Okay. So if you receive early payments for services or goods are taxed in a period they are received. So if you receive those payments early, you pay the taxes on them early, basically. The exception being customer deposits. This is a court case that it was ruled that customer deposits are not part of your income, that they are separate from your income. They're a liability for us for accounting purposes, but generally deposits are not income. Okay, so here's an example. We got Frida. She rents an apartment for $800 a month. On November 19th, she rents the apartment to a tenant starting in December. Frida collects 2 months' rent in advance and a $1,000 damage deposit. How much does Frida recognize in 2019? She's going to recognize the 2 months payment in advance, one for December and the other for January. Even though she hasn't earned the January one, she's going to recognize it. So she's going to recognize the December rent and the January rent. So she's going to pay tax on $1,600. The deposit is not taxed. So the 2 rent payments will be taxed, even though she hasn't earned the January one at the end of the year. Those will be taxed because she's received it. Again, the IRS says if you have the cash, you can pay the taxes. The deposit is not taxed. All right, non-cash transaction. You know, I realized when my microphone was attached here, it's in a funny position. Okay. Non-cash transactions. One of the things that a lot of times people don't realize is that non-tax transactions can get taxed. I said that wrong. Non-cash transactions can be taxed. And basically, non-cash transactions are taxed in the period the economic benefits were received. Okay, so Tom has a lawnmower and Jim has a snow thrower. Tom and Jim agree to exchange lawn mowing and snow clearing services worth about $600. So Tom mows the lawns in summer 2019. Jim clears the snow for Tom's driveway in January and February of 2020. Okay, so the question becomes, when do you recognize the taxes? Well, Jim got the benefit in 2017. So Jim has $600 in 2019. Tom got the benefit in January and February, so Tom will recognize $600 in 2020. And this is one of those things that people a lot of times will say, well, wait a minute, they just exchange services. Yeah, when you do a service and get something in return, it's income. Yeah. Now, take that same situation if Jim just mowed Tom, or I guess Tom is a lawnmower. If Tom just mowed Jim's lawn because Jim maybe is elderly or something, he says, I'll just mow his lawn for free. You don't count that as income. But if there's an economic benefit that comes out of it, then it's taxable. But it's taxable when you receive the benefit. So Jim got his lawn mowed in 2019. He recognized it 2019. Tom gets the snow clearing in 2020. Recognized it in 2020. Okay, loan forgiveness is another thing that is it's not you catch people off guard. Jill has a loan from her employer for $4,000. The employer dies, and in the will, her employer forgives the loan in 2019. How much of the loan? It's not very well written sentence, but how much of the loan is? Of the loan forgiveness is taxable, all of it. If you're relieved of your obligation, it's taxable. And now Joe will say, well, I didn't get any cash for this. I didn't know. It's as if somebody gave you cash of $4,000 and then you paid off the loan. So loan forgiveness is also taxable. And if you think about this, someone could give someone a loan, and then if this wasn't the case, someone give them a loan and then forgive it, and no one would ever be taxed on it. Tax-free income. From your business, your business could give you a loan, and then your business could forgive you the loan, and that sort of thing. So loan forgiveness is taxable. And again, non-cash transaction, no cash changed hands, but it's still taxable. Okay. These are it's out of focus. It's a little better. Okay. So page two. This is not a good pen. Okay, it's not a good pen, but it's the only one I have right now, so I guess we'll just use it. Okay, things to include in your gross income. We have interest income, dividend income. Those are two big ones. If they receive more than $1,500 of interest or dividend income, they must complete a Schedule B, which we will do next week. So next week we'll fill out Schedule B. Interest income is taxable except when the interest is from debt issued from governments, usually bond issued by a local, state, or federal government. So if they issue a bond for government type services, then it is tax exempt. However, sometimes you'll have a government that will issue bonds for a business. So for instance, they issue bonds to make a new sports arena or something like that. Well, that's a business. Those are generally not tax exempt. Same thing if you gave a bond to anyone, or you bought, from anyone else that wants to make a business. So interest from government bonds is generally tax exempt unless it is used as a business type of venture. Okay, so interest income is included, and we already know that. We've done that on the previous forms. Oh, by the way, just because these are not they're not taxed, they must still be reported. So even if these are not taxed, you still have to report them. You'll report them as tax exempt, but you'll still report them. And also, there are, for instance, filing taxes with the state. Just because the federal government doesn't tax those, states can. I believe still Illinois does. They used to in the past. I think they still do. But so just because the federal government doesn't tax those, doesn't mean the states don't. So some states will also tax government bonds, in interest on government bonds. So you must still report them. If you have more than $1,500 of them, you still got to fill out a form, Schedule B. Okay. Now, there are some dividend income rules that apply to dividends. And you might wonder, well, why is this? Well, one of the things about dividends and about taxing things like investments that you'll find is just part of life is, it isn't all wealthy people that get dividends. You have people that are retired who get dividends. So a lot of times, if you say, well, that's, wealthy people that own stock, and so that'll be, we'll tax them at a higher rate or as normal income. A lot of times that really is sort of unfair because the actual individual maybe is living off those investments, and that's their only income, or a big part of their income is that, and they don't make that much money. So the dividend rate of 0%, while you might say that sounds a little odd, it's really there because of, they want to encourage people to save for their retirement and all that sort of thing. And they also want not to tax people who are not wealthy but still receive dividends. Okay. So coming in here, so these are the rules for the dividends. So if the dividends are, these anything up to $78,750, if you're married filing jointly, you don't have to pay anything on the dividends. And going across here, you can see that. Now, there is one here that's a little bit odd. Usually the married filed separately thing kind of mirrors the single, but you'll notice that this is a very low number compared to the single rate. And you might think that's a little odd. Well, you got to remember, though, people that are married, they're filing separately. To discourage people from doing that, they are, here's what they don't want to do: have one spouse pile up all the write-offs, and the other one, not. So they want to make sure that they're not doing it to cheat on their taxes, basically. Married filing separately is for things like when you think a spouse is doing criminal activity. It could be a spouse is not around and maybe isn't filing their taxes. There's all kinds of things. Married filing separately is usually a last resort kind of a thing. What they don't want to have doing is someone doing that to avoid paying taxes on, especially very wealthy people. So making over $244,000 a year, to have them doing the same, for that same reason. Okay, so these are kind of the rates, and here's an example of how this would work. So this 80,340, this will be, we'll calculate the taxes on this before we do the 1,200. Okay, so Sarah's single, and she made 80,000, excuse me, 3,040. So single, she's down here, so the dividend is going to be taxed at 15%. So we'll go to our handy table and see what the taxes are on that. All right, so this is, I don't want to use that one. Smudge it. Okay, so Sarah made 80,340. It's under 100,000, so we can use, or under 99,000. No, under 100,000. We can use the tables. Let's see, the table for her is page 10. Okay, so Sarah made 80,000. Good way to do this. Ooh, maybe that'll do it. Yeah, no, it won't. I'm too high up. Okay, so this is on page 10. 80,340. 80,000. 58,000. So it's here. And the first one here are the single tables. I think I promised you last guys I was going to make these bigger, and I never did. Okay, so that looks like, take off the glasses, 80,340 B for something who's single is the first column, I believe. Let's check and make sure. Yes, first column. Go to the table, and it is the tax is $13,530. Okay, so that would be her taxes for the 80,000. So this would be her job, or as a W-2. Her dividends would be, she is in here, 15%. So she made 1,200. What is it, 180? I better get the calculator out. I better put the glasses on first. You will see the calculator. All right, here we go. So 1,200. I think comes out to 180 times 0.5. Yeah, so let's do 180. So this will be your tax rate. By the way, you may want to check me on that table. You guys have, I'm sure, figured out by now. Sometimes occasionally, I'll make a mistake. Oh, you know what? I just wrong. This is the, I'm sorry. I think I said 80. This is what we're looking at for this one. She's single. But the 80,000 is certainly above the 39. So again, they get taxed at a different rate. And again, the reason for that is that not everyone who receives dividends is necessarily wealthy. That they get a break on the taxes on the dividends. Okay. State and local tax refunds are taxable if they are received in the current year, and state and local taxes will be deducted in the itemized deduction on Schedule A of the previous year. All right, so if they itemize the deduction and they will put it on their on the Schedule A, it's possible they elect not to, but if they put the state and local taxes on there, then when they get the refund back, it's sort of like getting back some of the taxes that they had claimed on there. So that counts as income for them. Now, if they use a standard deduction, they don't have to worry about that. You get a standard deduction, you get a refund back, don't worry about it. It's only if you did an itemized deduction. If you decided not to do the standard deduction, the itemized deduction, then if you get a refund though and you're using the standard deduction, which is 90+% of the people, you don't do anything with it. It's money you paid in that they returned to you that was not used. So federal and state unemployment compensation benefits are taxable. So unemployment, and if you think about it, unemployment is there to replace your regular income, so it's picked up as regular income. Yeah, the usual thing with this COVID thing is, those stimulus payments. Is that people who are unemployed, they got those extra payments that a lot of times those are taxable. Sometimes they're making more money doing that than they were at their jobs. The difference being is the money withheld. So there's probably going to be people with tax, liabilities for that coming next year. So if you're doing taxes for someone who gets those, it's probably going to be they owe money. Okay. Social Security benefits are a complicated thing because you're talking about giant, as population as a whole, giant sums of money. That there are, the number of people receiving Social Security benefits is huge. Now, those people that are at the lower income brackets, it's, you don't want to tax those people. They need that money to live and that sort of thing. But as the income increases, there's some people that are very wealthy who receive an awful lot of money besides the Social Security benefits. So at some point in time, those Social Security benefits become taxable. And the question is, well, when does it kick in that those become taxable? And so that's what kind of these rules are, and they're actually kind of involved in as you go through them. But they start out with your adjusted gross income, and they talk about interest on savings bonds. Those are usually and tax exempt. Again, here's tax exempt income. Now, for finding out your adjusted gross income, this tax exempt income doesn't count. It does count when you're talking about computing whether the Social Security benefits are taxable. So this is one of the reasons why you have to put that on your tax form, is that even if it's not taxable, because there are different things that may come into play. Employer provided adoption benefits, excluded foreign income, deducted interest on educational loans. So if it's an education loan, that gets added back in. Deducted tuition fees, those all you put in. And 50% of the Social Security benefits themselves, and that'll give you your provisional income. And the provisional income down here says that, a certain amount of your income could be taxable. So the Social Security benefits are taxable. So if they are taxable, whatever you get for the Social Security benefits, half of those would be added in and be taxable. And they have some limits here, though, that, the lower limit is 32. So anyway, there are limits that it depends on. It isn't everybody that has to pay that. It's only if this provisional income comes up to a certain point. All right. Excuse me. Okay, so let's go to. Oh, yeah, we're doing good. Items excluded from gross income. Some fringe benefits to employees are not included in their income, even though they are a benefit. For instance, things that have no additional cost services provided to an employee, his or spouse, or dependent children. So, for instance, if they have an exercise gym that they allow employees to go there, but and they also allow their families to go there. Well, the gym, probably doesn't cost anything really to have other people show up. They get the building, they get the machines, and all that kind of stuff. So no additional cost for the services. They don't have to pick those that add up as income. Discounts provided to employees or services normally sold by the business. Okay, so if you're at a company and they give you a discount on, let's say we're at a clothing store and they give you a discount on the clothing. They say you get 20% off or whatever it is, 15, whatever it is. You don't have to count that 15% as income. No, it is true that working there you got that benefit, but you don't need to count that as income. So there, that's one of those benefit things that even though theoretically it's income, the IRS does not count it that way. For products, the discount cannot exceed the gross profit percentage. Okay, so this is what they're saying there. So let's say that you have an item that has a price of $100, and you have an employee discount of, say, 20%. So they get 20% off. So if you want to buy that item, you'd pay $80 for it, right? All right. What they're saying is that the discount cannot exceed the gross profit percentage. Now, if this item had a cost of, say, $85, so the gross profit was 15, you would be taxed on the $5. It's the difference between those two. Usually this isn't the case. Usually employee discounts are about what they pay for them, or less. Or I should say that the discount is not the same as their gross profit margin, that they don't actually get. In this case, what it really is, if the employer paid $85 for it and sold it to you for $80, what they've really done is given you $5. They gave you something that had a cost of $85, and they gave it to you for $80. So you pick up that $5 as income. So it cannot exceed what the gross profit that they make on it. So now, if the cost was 65 and they made 35 on it, well, then that's fine. Keep the whole 20. And again, most time employers don't, it's the same, or they give you less of a discount than you would to bring it down below the cost. But it's possible. All right. For services, the discount cannot exceed 20% of the normal selling price. So if you get a service rather than, if you work, I don't know, I have no idea if Comcast gives discounts to their employees or not. But if they did, it cannot exceed 20% of the normal selling price of the discount. So if they gave a discount of 30%, the employee would have to pick up the extra 10. So it cannot exceed the normal for services. Okay. Yeah, and they don't worry about what the cost is on all that. It's the service is just 20% of the normal selling price. Okay. Working condition fringe benefits. And these are things that a lot of times people, if they itemize their taxes, they would pick up on anyways. Professional organization dues. So, for instance, you guys are accounting majors. You may have someone, you may be a CMA or a CPA, and you have dues for those that you have to pay to those different organizations, or even for your licensing. Those are not taxable. And the idea being is that it benefits the business, to have you in those organizations. So, qualified transportation fringe benefits, parking benefits cannot exceed $265 a month. Van pool cannot exceed $265 a month. So they can provide transportation benefits, but they cannot exceed $265, and this changes. De minimis benefits. Bloody turkeys. So someone hands you a turkey, you take it and say thank you, and you don't do anything else with it. So things that are and generally there's a few rules on with dollar limits and all that kind of stuff, but generally those things that are of minimal value you don't have to worry about. So they can give you an award, give you a turkey, give you whatever, and it's not that, as long as it's a minimal amount. Okay, additional types of excludable benefits. Accident and health insurance. These are big, especially the health insurance. This can be $20,000 or $30,000 a year. That is not taxable. So health insurance is a huge one. Group term life insurance premium is up to $50,000. I'll tell you a strange one with that. This came up when I used to work at Robert Morris University. We were bought out by Roosevelt. But at Robert Morris University, they used to give us $1.5 million of life insurance. And we used to have to pay taxes on it. It was taxable. Because anything over 50,000, so 50,000 of that wasn't taxed, but over 50,000 was. So we would get, but it's kind of funny because it was, everybody, if you were there for more than a couple of years, you got it. And there were people that actually had, collected on this policy. There was actually some people that died, and they collected on the policy. And think about it, that's $1.5 million. And it's basically gonna be tax free, when they actually get it. We'll talk about that in a little bit here, but so life insurance up to $50,000 is, you don't have to pay taxes on it. Over 50,000 you do. Cost of employer of employer paid meals and lodging if furnished for the convenience of the employer on the business premises. All right, so they ask you to stay late. They say, everyone stay late. We got to get this done, and we'll buy pizzas. You don't have to pick that up as income. It's for the convenience of the employer. They don't want you going home. They want you staying there and doing, finishing up whatever. So, and sometimes they'll even, I know that they put up people in hotels and stuff, even on closings and stuff. They don't want people going home and then coming back, to work. So especially things like, in large cities, going in Chicago. People that work in Chicago that at the month-end closings, they would rent out rooms for employees to go to, so that they didn't have to, they didn't have to drive home and then come back and deal with all the travel. Oops. Dependent care assistance up to $5,000. In addition, exclusions cannot be exceeded in days of earning income lesser than earning spouse married filing jointly. It's probably not that big of a deal. But if they have dependent care assistance, for instance, child care, whatever, that up to $5,000 a year. Flexible benefit plans or cafeteria plans. This is when you get to choose what things that you take, what things you don't take for an employer. You get to pick and choose. And the same thing for that one. All right. Hey, we're on the last page already. Woohoo! A little longer than I thought, but not bad. Okay. Now, these are some things that I should have left space in here. I don't know why I didn't. We got the whole paper. I don't know why I didn't do this. Non-taxable income, not directly related to employment. So these are things that are not related to employment. So scholarships and fellowships. So if you get a scholarship or fellowship, that's not. Qualified tuition program withdrawal. So if you withdraw money that's put into a qualified tuition program, as long as that money is spent on tuition, it's fine. Life insurance proceeds. That is the craziest one, but it's there. The IRS does not tax life insurance proceeds. So when you get a life insurance plan, if you're a beneficiary of it, you get that free and clear. You don't pay any taxes on it. I know that sounds odd, but they also do not allow tax deductions for life insurance premiums. So if you say, well, I pay these life insurance premiums, I want to write those off my taxes, you can't do it. It's not like medical, that's not a medical payment. So they don't let you write off the premiums or for businesses either. And they also do not tax the proceeds. They are completely hands-off when it comes to life insurance. Their view of it is that it's an investment. That's the IRS deal. Life insurance is different than fire insurance. Life insurance is always collected, right? I mean, no one lives forever. So life insurance is considered different than most normal insurances. They say, no. And the same way you can't buy, say stock and write off that cost. You bought something for it. You bought an investment. Same thing here. When you pay a life insurance premium, you're buying an investment. No one lives forever. This is going to be paid out at some point in the future, definitely. So it's an investment. When it's paid out, it's not taxed. Okay. Gifts and inheritance. This is one of those things that is a little bit strange, and that is if you get a gift or an inheritance, the person receiving it does not get taxed on it. The state gets taxed on it. So whoever gives the gifts or the inheritance gets taxed on it. There's limits on how much they can give to somebody. So if they go over those limits, let's say they give $100,000 gift to somebody, whoever gives that gift pays the taxes on it, not who receives it. So that's one of those things that's a little bit odd. But a gift is not taxable. The payment, whoever paid it, gets taxed on it. So when they talk about gift and inheritance tax, what they're talking about is the tax on the person that's giving it. The reason why we have gift and inheritance taxes is that if you didn't do that, certain people with unbelievable wealth would just keep getting wealthier and wealthier and wealthier and wealthier, and that there would be never-ending chain, and you'd end up with basically royalty or something like that. So gift and inheritance for people that really didn't necessarily earn anything. Compensation for sickness or injury. So unemployment benefits don't get taxed. If it's compensation for sickness or injury, it does. So there's a difference between those. So compensation for sickness or injury is not taxed. Child support is not taxed. That's money. Now, whoever's paying it might pick them up as a dependent, but the child support itself is not taxed, just like it wouldn't be taxed if the two people were living together. So child support is not taxed. Book assistance payments are not taxed. And employer-provided adoption assistance isn't taxed. You still have to report that, though, because of what we talked about before, which is possibly on the Social Security, which is nowhere to be seen here. Oh, here it is. Yeah, the adoption benefits. So those are things that are not taxed. For the person. So, and the ones that always come up, though, are the life insurance and the gifts. People when you say, oh, they just received $1.5 million, they don't pay taxes on it. And I'll tell you about when I was at RMU, another thing that happened, this is the craziest thing. We had an employee who was older and she had cancer. And she ended up refusing, the life insurance because she got hit with it on the taxes. And on the taxes, she had to pick up $12,000 of income. She has 3 kids, or all living. They didn't want to pay this. Notice how crazy that is. They could have paid $12,000 for her taxes. They collected $1.5 million tax-free. I think there's 3 of them. So for $4,000 each, they could each walk away with $500,000 tax-free, and they didn't do it. So it's one of those things you just slap your head. You can't believe. Well, it's just because they don't realize. I don't know what they didn't realize. Even if you were taxed on it, you'd still want to do it. I mean, $12,000. You get someone with terminal cancer, and crazy. So anyway, we'll call it a day for this. Next week we're going to go into the tax forms. We'll do the schedules. I believe we do the Schedule A, and I believe we do the Schedule B. But we'll take a look at it next week, and then we'll also do the 1040s. Those all fold into the 1040s. Okay. Any questions? All right, and I'll get going on checking in your stuff from last week. I haven't looked at it yet, so I will do that. I'll do that tonight. I'll get the stuff in. All right. Well, we'll continue with this next week. No homework. We'll just this is the handout. What we have. Don't turn this in yet. I think I'm going to add on to it. I'm probably going to add on to it for the life insurance proceeds. There's and kind of the pension stuff that we'll talk about a little bit. So I'm going to add that on because you do run into it quite a bit. Okay, questions? All right. Well, I will. We'll talk to you guys. I'll talk to you guys next week. And I know I keep saying I'm going to be in my new Zoom room, and it hasn't happened yet. But I am determined to get the Zoom room done. And so this next week, come whatever, I'll be in my Zoom room and out of the closet. My new Zoom room, not the closet. All right, guys. Have a good evening. Thanks. See you guys.